Hey, welcome back to another episode of the Mortgage Musketeer, where today we're going to be talking about self-employment. Self-employed borrowers, yes. Breaking down what you need to buy a home if you're self-employed. Alright, so the short and simple answer is that underwriters are going to look at your adjusted gross income. Your adjusted gross income is after all of your deductions. So there is a distinct conflict, and this is why self-employed buyers have a hard time buying a house sometimes, is because we want, in general, to pay the least amount of taxes as possible. And your CPAs are encouraged to make it so that you pay the least amount in taxes possible. So that means that they are kind of going to be championed or rewarded for providing the most legal deductions to reduce your income, to reduce your taxes. When you have a really good CPA who's very successful, the irony is it reduces your buying power because it reduces your adjusted gross income. So all of those deductions that they've written off come off of your income. So if you think you made $200,000, but you've got $120,000 worth of deductions, your adjusted gross income is $80,000. That is your income that can be used for underwriting. It's pretty straightforward. So when you are thinking about buying a home, or when you are self-employed, you have to start thinking about that difference. So nobody wants to pay more taxes, but if you want to buy a house, you want to increase how much income you get credit for. So you might have to pay taxes, a little bit higher taxes, for a couple years. Now, this is how that works. An underwriter, or the most guidelines, are going to look for 2 years of tax returns. Okay? You have to be employed, self-employed, for 2 years. So I get it all the time where people say, yeah, I just started my new business, I'm doing really well. And I said, well, when did you start it? Well, we started 7 months ago. Okay. It has to be 2 years of tax returns. Right? So think about that as far as timeline, because it can exceed 2 years. So if you started in July and your first tax return is going to be like 5 to 6 months, you're not going to have a whole lot of income. Of course, you're going to have increasing income, which is good, but they would average the 2 years. So you may have to have more than 2 years of tax returns to qualify. Okay? So, or let's say that you started in January, February. All right? So you have to wait until you have 2 tax returns. Or if you started at the end of the year, towards August, so you get the idea. So if you had 2 tax returns, if it was August to the following year, you may have 2 tax returns, but it's not going to show all the income potential that you have. So what I'm saying is that it could take up to 3 years to actually have income that would actually qualify. Every situation is different. Now, if you've been self-employed for more than 5 years, we can normally go off of 1 tax return, your most recent tax return. However, it is completely dependent upon the automatic underwriting findings, so we have to submit it. Now, if you are a self-employed buyer, your loan officer, before they do anything, should get your tax returns. Now, we only need your federal, no state tax returns. So that's just, self-employed buyers have a lot of tax returns. If they're all together in PDF and you send them, that's fine, we'll separate them. But if you do have them separate, only send the federal. Now, depending on the type of business that you are, is what kind of tax returns that you file. So when you are self-employed and maybe you don't file business tax returns, it's all going to be on your personal tax with your 1040 and a Schedule C and whatnot. And you might have a Schedule E for rental properties. So you have to provide all of your federal tax returns, all schedules. If you filed in a way where you have business tax returns, you have to supply your personal tax returns and you have to supply your business tax returns. And most importantly in there is your K1. We need all of those. We need your personal, your business, and your K1, because that K1 is going to break down what percentage of ownership you have in that business. And that can impact how your tax returns are looked at. So be sure to dig up all of your tax returns and hand it in to your loan officer. Now, what is your loan officer going to do with it? Now, they should be taking a look at, well, first of all, your adjusted gross income. So in 2018, the adjusted gross income line on your taxes is on line 7 on your 1040. And in 2019 is on line 8B. So every time they change the tax returns, the form, it may move around, but what you were looking for is your adjusted gross income. Now, in general, that's your income. However, there are some things that we can add back into your income. For instance, on a Schedule E in your rental, and I've seen so many people that'll write everything off so that they have they may make $1,000, bring in $1,000, but they've written everything off and they're showing zero. There are things that we can write back in, we can add back in. So we have to see it and see what you did and how your CPA prepared your taxes in order to figure out how much income maybe we can give back. All right. Self-employed tax returns are pretty complicated. Now, there are a lot of lenders out there who will take what's called a TBD, to be determined. So you can actually, me as a loan officer, I can take your tax returns, I can figure out what I think you're going to get credit for, but it comes down to underwriter. What is the underwriter going to give you, right? So I can submit your file with your tax returns and get an income determination and take the guesswork out of it. So we know exactly what they're going to give you for your income so that we can turn around and find out and build your loan for what you actually qualify for. All right, so if you are self-employed, know that you're going to need, on average, 2 years of tax returns. And then how is that looked at? If you have a lower income 2 years ago and then a higher income last year, they're going to average the two. If you had a higher income the year prior and a lower income this year, they are going to use the lower income because you have declining income. It shows that you're riskier, and you're probably going to need a letter of explanation explaining why did you have declining income. And then it becomes a little bit of underwriter discretion. If they're not that far off, not a big deal, but if it's a big deal, maybe the answer is actually in the tax returns. Could have had a big write-off for an expense. Every tax return is different, which is why submit your tax returns to your lender. If your lender's trying to pull your credit before they look at your tax returns, it really doesn't make sense, because I've seen so many people that write so much stuff off that they don't qualify. They don't. They could be making $250,000. I had a guy making $450,000 a year one time, and on taxes, when I look at his adjusted gross income, it showed $60,000. Now, can he afford, a $500,000, $600,000, $700,000 house? Absolutely. I mean, the money coming out of his bank account, 100%. But for qualifying income based on his adjusted gross income, no, he didn't. He only made $60,000 and couldn't afford the house that he wanted. Now, this is important to understand. It is people who feel frustrated. I make all this money. Well, you chose to write off all this money because you're avoiding the tax penalties. And then on the other side, it's going to kind of ding you as far as your qualifying income. Adjusted gross income. That's the key word. Now, how can we get around that? Well, there are loan programs called non-QM loans where you can do bank statements. So if you are receiving all of your income into your business bank account, we can show 12 to 24 months of that, or your personal bank account, 12 to 24 months of deposits. And there are lenders who can take a look at that and not look at your tax returns. They'll only look at what is deposited into your account, and then they'll average it over 2 years. Now, those loans are a lot riskier for the lenders. As a matter of fact, right now, during the whole coronavirus thing, they're done. You can't do them. So they're out of the picture. Until the market stabilizes and things get better, they are not taking any of those type of loans. Once things stabilize, I'm sure that they will come back. They were just picking up a lot of steam, and the reason they were picking up a lot of steam is for exactly what we just described. Is because so many people will deduct as much as humanly possible in order to reduce their overall taxes. And that's normal. But if you're going to buy a home and you're self-employed, keep that in mind, especially if you're starting out. Don't deduct all your taxes. Pay more taxes. It's going to hurt. All right, I get it. Trust me. But pay the taxes so that you can use your new awesome job that you've built to buy a home. Or before you start your self-employment, buy your house. Buy your house while you're still W-2. Get in the home, then go self-employed. That's an easy solution. All right. So tax returns can be a little bit complicated, but I just want you to know that a loan officer's job is to go through them, figure out what you qualify for, and let you know what you can and can't do. So it should be a partnership. Partner up with the loan officer, see if they can even do a to be determined loan where they get the answer from the underwriter, and we'll see about getting you into a home. Hope this answers a lot of your questions. If you have any additional questions, put them in the comments below. I'm happy to answer them. And until next time, it's all for one and one for all.